Okay, let's say you decide you want to own a skyscraper. Not a floor, not a penthouse at the top with a nice view. The entire building. Every office, every retail unit, every elevator that decides to break down at 2 in the morning. The first problem sounds obvious. You need an enormous amount of money. A single trophy office tower in Manhattan can cost more than $3 billion to build from scratch. That's roughly what SL Green spent putting up One Vanderbilt, the super tall next to Grand Central that now commands some of the highest office rents in the country. $3 billion for one building on one block. The second problem is more interesting, and it's the one nobody warns you about. You almost certainly don't need anywhere near that much of your own money, which raises the real question this video is actually about. If nobody writing that check is putting up the full amount themselves, who is, and what happens to you if the bet goes wrong? What the number on the building actually hides. Start with the sticker price because it's bigger and stranger than people expect. 1. Vanderbilt. Around $3.3 billion. The Burj Khalifa, the tallest building on earth. Roughly $1.5 billion. Built in a market where land and labor were dramatically cheaper. Same category, super tall, iconic, headline making, wildly different price tags because the cost of a skyscraper has almost nothing to do with height and almost everything to do with where it happens to be standing. Here's what those numbers don't tell you. Nobody pays that figure out of pocket. When SL Green built One Vanderbilt, it didn't write a $3 billion personal check. It borrowed roughly $1.75 billion in construction financing to get the building up, then later refinanced the completed tower with a $3 billion 10-year loan arranged by Wells Fargo and Goldman Sachs. On top of that debt, it brought in partners, Heinz and Korea's National Pension Service, to share the equity. Years later, it sold an 11% slice of the tower to a Japanese developer at a valuation north of $4.7 billion. So who owns One Vanderbilt? 2 institutional partners, a foreign pension fund, a Japanese conglomerate, and a syndicate of lenders holding the debt. That's not a building. That's a cap table with a lobby. The trick that makes the whole thing possible. This is the part that changes how the rest of the video should be understood. Wealthy real estate investors almost never pay for a skyscraper with their own cash. They use other people's money, banks, bondholders, pension funds, joint venture partners, and keep a slice of the ownership for themselves in exchange for finding the deal, managing it, and taking on the risk. This is leverage, and it turns a billion-dollar building into something closer to a bet placed with borrowed chips. If you put down 20% of a building's value in cash and borrow the other 80%, every 1% swing in that building's total value moves your actual equity by roughly 5%, which means the same tower that makes an owner look brilliant during a boom can wipe out their entire stake during a downturn, without the building itself changing at all. The concrete never moves. The equity underneath it does. Constantly. How a skyscraper actually makes money. So assume you've assembled the financing. Now, the building has to earn its keep, and this is where a skyscraper stops looking like one asset and starts looking like several businesses stacked vertically. Office rent is the anchor. At One Vanderbilt, asking rents have topped $300 per square foot, among the highest in the city because tenants are effectively paying for prestige as much as square footage, but rent is only one layer. The Empire State Building generates a separate, enormous revenue stream that has nothing to do with office tenants at all. It's observatory. In 2024, that single attraction brought in close to $100 million in net operating income for the year, money from tourists who will never sign a lease, riding elevators to look at a view, layer in retail, restaurants, event space, and in some cases hotels and residences, and the building starts to resemble a small, vertical city with several separate income statements. The Burj Khalifa is the most extreme version of this. Residential units, a hotel, corporate suites, an observation deck, and a restaurant, all stacked inside one tower. Though it's worth being precise here because Amar has never broken out a single confirmed number for exactly how much each of those pieces earns. Outside estimates for the observation business alone have ranged into the hundreds of millions a year, and Amar has reportedly explored selling that single attraction for close to $1 billion on its own. One piece of one building, worth that much by itself, where all of that money quietly disappears. Here's the part that erases most of what you just heard. Every one of those revenue streams runs straight into a wall of fixed costs that never take a year off. Start with debt service. Empire State Realty Trust, the company that owns the Empire State Building, carries roughly $2.3 billion in total debt at an average interest rate north of 4%. That's not a one-time bill. That's every single year, regardless of how the observatory performs. Add property taxes, which in a city like New York can run into the tens of millions annually for a single trophy tower. Add insurance, which has climbed sharply industry-wide. Add the unglamorous stuff, elevator maintenance, HVAC systems that run nonstop across dozens of floors, window washing rigs, security staffing around the clock, and the capital expenditures that come from just being an aging piece of machinery wearing a nice suit. Then add the cost of keeping tenants at all, leasing commissions, tenant improvement allowances to build out someone's new office exactly how they want it, and the gap between when a lease ends and a new one begins, during which an entire floor earns nothing while still costing the same amount to maintain. A skyscraper doesn't have a slow month. It has a slow month with the same electric bill, the risk that can turn a trophy into a write-off. Here's where the fantasy really breaks down, because a building can look completely fine right up until the moment it isn't. Take 1740 Broadway, a 26-story Manhattan office tower owned by Blackstone, the largest owner of commercial real estate on earth. Blackstone defaulted on its $308 million mortgage on that building in 2022. By last year, the tower's appraised value had fallen by more than 70%, and the defaulted loan itself was being sold off at roughly half its face value. This is Blackstone. Not an inexperienced first-time buyer, the single largest, most sophisticated real estate investor on the planet, walking away from a Manhattan office tower, and that's not even the most dramatic example. One Manhattan office building, roughly 1 million square feet, sold in 2024 for $8.5 million, a 97% collapse from the $332 million it fetched in 2006. Same steel, same address, a fraction of the value because the tenants that once justified the price simply weren't there anymore. If a professionally financed, professionally managed Manhattan tower can lose 70% or even 97% of its value without a single wall falling down, what does that tell you about the number printed on any skyscraper's price tag? It tells you the number was never really about the concrete. It was always a bet on rent, on occupancy, and on interest rates holding steady long enough to pay off the debt before the world changes underneath the building. Could you actually own one without being a billionaire? Here's the answer, and it's more layered than buy shares in a REIT. You genuinely can own a piece of Empire State Realty Trust, the public company that owns the Empire State Building, for whatever a single share costs on the stock market. But that's a world away from controlling the building, deciding who leases the 40th floor, or picking up the phone when the elevator breaks. Between those two extremes sits an entire spectrum. Joint venture partners who put in equity alongside a lead developer, pension funds and sovereign wealth funds that fund a slice of a tower like Korea's stake in One Vanderbilt, private real estate funds that pool money from outside investors, and mezzanine or preferred equity investors who sit between the bank and the owner, taking a smaller but safer slice of the deal. So owning a skyscraper was never one thing. It's a ladder. At the top, a handful of institutions and billionaires control the decisions and absorb the sharpest losses. At the bottom, anyone with a brokerage account can own a fractional, diversified sliver of the same asset class with none of the control and almost none of the catastrophic downside. The real answer. So, brilliant business or financial nightmare? It's neither, by default. A skyscraper is a leveraged, decades-long bet on three things staying roughly in your favor at the same time: who's renting the space, what the debt costs to service, and whether the world still wants a building exactly like yours by the time the loan comes due. Picture the good version. Rents hold, occupancy stays near 90%, Refinancing happens at a manageable rate, and the observatory or retail underneath keeps generating cash that has nothing to do with office tenants at all. Much like Empire State Realty Trust's own numbers show today. That building compounds in value for decades and becomes exactly the trophy asset it was sold as. Now, picture the other version. Rates rise right as a loan matures. A couple of anchor tenants leave at once. The building that looked bulletproof on the day it opened turns into 1740 Broadway, 70% of its value gone. The owner walking away, the lender left holding a very tall, very empty problem. Same tower, same steel, same skyline. The difference was never the building. It was the debt sitting underneath it the entire time, waiting to find out which version of the story it was going to get.